Good morning, everyone. Welcome to the day's next session. It's called Financing the Future, Investing in Regenerative Finance and Climate Tech Innovation. My name is Terry Wiseman. I come from the New York office of Macquarie, Australia's global investment bank, where I serve as global interest rates and currency strategist. That's a job that's a lot more mundane than what these fine panelists do. I'm joined this morning by these fine panelists, this weird set of panelists. I'm going to follow the protocol that Sid did. I'm going to let each of you introduce yourselves as opposed to introducing you, and we don't have to do it in the alphabetical order. Just start from far to close, and we'll get started with the questions and the.
All right. Hello, everyone. I'm Brian Johnson. I'm a partner at Republic Capital. I co-manage and run our crypto investment arm.
Good afternoon, Catherine Atkin. I'm an attorney and an entrepreneur as well. And I think I'm wearing a couple hats here. One is the UGIH Innovation Hub, where we focus on need-based climate solutions for the UNFCCC, but I also run a project at Stanford Law School, and I'm here to talk about how we take all of this to the next level. Excited.
Hey everyone, I'm Wes Geisenberger. I help lead the HBARC Foundation Sustainable Impact Fund, a grant fund for digital public goods in the Hedera ecosystem.
Hi, I'm Alexis Norman, so I'm CEO, co-founder of Greenly. We're a carbon accounting platform working in the US and in Europe, serving 2,000 customers, just about.
And I'm Justice Killian, a managing partner at Space Capital, and I'm here to focus on the intersection of satellite data, how it helps create a foundation of transparency and accountability, supporting the climate markets.
Thanks, guys. I'm going to try to motivate this panel and this discussion by talking about ReFi and just my views and where this might all go in this discussion. I think that at its simplest level, ReFi defines itself in opposition to traditional finance, or TradFi, and TradFi, obviously, has been criticized in the past few years in a number of ways. It's been criticized for putting short-term profits ahead of longer-term sustainability goals. And when you look at it this way, ReFi could be thought of as any finance model that doesn't put short-term profits ahead and doesn't ignore sustainability goals. But if we define ReFi that way, we're kind of defining it in a negative sense. And I guess what I want to do with this panel is maybe try to get to what ReFi is, but in a positive sense, not to define it in opposition to what TradFi is, but talk about what it is as opposed to what it isn't. So what we should ask what ReFi is, effectively. We should try to get to an answer in that respect. Is ReFi just ESG-oriented investing, but with better accounting, tracking, and monitoring tools? Is ReFi there to punish bad climate actors, while ESG in another generation or another period was there to reward the good ones? That's another way to think about it. Is ReFi just a mere branch of ESG investing, or is it fundamentally different because it improves or regenerates environmental well-being, whereas ESG investing is merely traditional investing without doing any harm? Is that the way we should think about ReFi? Another way we can think about it is it just a version of ESG investing that levers the blockchain and the digital economy? I hope we can touch on that a little bit. Is ReFi going to be the killer app of the Web 3.0 economy? What other tools does it make use of that TradFi does not make use of? And are there other technologies and institutional frameworks that come into the pictures in ways that are special to the ReFi model of finance, such as space technologies or legal frameworks? These are the broad questions I'm hoping we can bring up, and I hope that the panels can address. So with that, I'm going to start with the first question I had in mind. I thought I'd kick it off with a question directed to Brian first. Maybe Wes can chime in, anyone else or any others. Some people say that crypto and tokenization are still looking for their killer app, besides the streamlining of financial transactions, for example. What are you guys seeing in crypto land, let's say, that gives you reason to believe that tokenization may be the first killer app? That tokenization may be the killer app in the ReFi model of doing business. In other words, is Web 3.0 going to be where, is ReFi going to be where Web 3.0 finds its killer app, is I guess the way to put it. So, any of you? Go ahead.
Directed to me.
Yes, go ahead.
One word, dClimate. Well, as an investor in dClimate, obviously I'm biased, but I think in terms of the killer app, crypto, we're still really not there in terms of mass adoption. Obviously, it's still a very high learning curve. But the core premise of the technology and the reason for the technology is trustlessness and immutability. And with the issues with carbon credits in the past, and I would argue today, is that there's still a lot of bad actors, people faking it, and with crypto we're able to verify that through the use of blockchain technology. So really abstracting away the digital learning curve of crypto, I think, is important, and dClimate is one example of how that's being done. We just need actually to show how it's used and the benefits of it, and I think once that is more prevalent, it's really a marketing issue more than anything. I think we'll see more of that adoption and the killer app use case and validation.
Wes?
Yeah, so I think tokens are something that we talk about a lot. We talk about fungible tokens, things we trade in the crypto world, but they're also a tool. They're a tool to shine light on information. A token could represent a carbon credit, a biodiversity credit, a carbon emissions token as examples. So I know there's a few folks in the room here today who are part of the Voluntary Ecological Markets Task Force as part of Global Blockchain Business Council. We don't just define standards as a token, we actually define the measurement, reporting, and verification. And so ReFi, using tokens as part of the tool set, makes a ton of sense, but they're not the only tool. And there's other ways to use that immutability and those properties from a ReFi perspective to map out the rules that we're using in climate markets, map out the data, could be dClimate data, but it could be a lot of other types of data that actually come back to local communities, give them the ability to attest themselves, receive value in the same accounts that they're attesting from, and prove, that funding is going where it should go. The value of a token in many cases for carbon credits, which we're often talking about in ReFi, is, in my view, getting funds that we can prove go back to the community for that token, link that to the audit trail because we have the rules mapped out on public ledgers. Those are shared rules that we can all see, and we can see the data used against those rules coming not from one party, like a verifier talking to a registry, or a project developer talking to a verifier who takes it to a registry, but having data come from many different parties contributed in a decentralized way that improves the trust of the ecological data and the trust of the financial system reaching folks who need it.
Thank you. Anyone else?
I'd go a layer deeper and say that the goals of ReFi to create ambitious change at a global scale require blockchain and its ability to create transparency around actors, data sources, actions as being foundational in its success. I think alongside of that, space technology actually plays a powerful role in generating the data that can help validate what's happening and ensure that the collective efforts, these aligned incentives that we're trying to put in place, are not just a placebo.
And if I may add, your point about generating certification for the reality of offsets is a good one because, as many here probably know, there were a lot of scandals that offsets were very optimistic assumptions of carbon avoidance that couldn't be tracked back to the reality of forest projects and so on. But they had good certificates because it had been audited a few years back. So part of the mistrust that you have today in offsets is due to the lack of verification and the discrepancy in time. So I suppose that a certification system that would be more real time with, I guess, a kind of timestamp that worked better could be there, but it's highly theoretical. No one is actually doing it well, to my knowledge, today.
So there's a handful of companies that are doing direct observations. What's interesting is the barriers within building, launching space technology, particularly satellites, to be able to look back at our Earth and quantify activities have really come down over the last decade. We're now at a point where students in university can build and launch satellites with specialized instruments, collect that data, and begin to analyze it. And so on the back of that innovation, you're able to see nonprofits like the Environmental Defense Fund launching a project called MethaneSat, $100 million project to detect, quantify, measure, and sort of roll back in time sources of methane emission at a global scale. They'll make that data free and publicly available. There are private companies doing this as well. A Canadian company in our portfolio called GHGSat, they're able to measure methane and carbon emissions and roll them back to point sources to actually create transparency and accountability in what they do. So those are two examples at the moment.
Yeah. One thing I think we need to think about though for ReFi is there's building blocks. There's building blocks. We talk about the rules, right? Methodologies. Whether it's in emissions accounting, scope 1, 2, 3, or product carbon footprints, or voluntary carbon market projects, or biodiversity projects, they all have rule sets. Those rule sets need to be out there for people to explore, adjust, improve, right? You know, we have forestry rule sets where people used versions of the rules to get a credit, which was a valid credit, and you know that could be improved. You know, this isn't all these rules from a single registry aren't credible. It may be paths to get to those credits may not be optimal anymore, or we have better tools and technology to improve it. And so we should move the markets forward by bringing the enabling technologies to make it possible. You know, what we've done is we've invested in the infrastructure systems to make it easier to build the rules faster. Instead of it taking a half year to a year to build an environmental rule set in a digital way, we can get it down to a couple weeks. You know, we can take Masters of Environmental Science students who are familiar with building out spreadsheets, whether it's for emissions accounting or offset projects, and pair them with a developer. And in 1 or 2 weeks, they have a rule set and they can start inputting data that they would be getting from a project developer, or we're taking it from satellites, and giving attribution to where that data has come from. That exists, that tool that's called the Guardian exists today. We have the largest library of open source rules that are available today that anyone can contribute to. And we help fund the roadmap to make it possible as a digital public good. Now, that doesn't just work for offsets. You know, folks want to improve carbon emissions accounting, a really big area of the market that, you know, is probably underserved from a thought process and investment perspective. You know, we can better do that collectively than building simple calculators that have to be readjusted and readjusted and readjusted, and then venture companies have to reinvest and reinvest, which leads to a very large software market, but maybe not as granular of outcomes that we could have. And those are the types of things that every company can use today. Every company can buy and invest in. But ReFi, by building kind of those layers of the cake or the Lego blocks, can work together to get to those quantifiable outcomes that use tokens, immutability, different data sources together to get to a regenerative process that we can build a system of knowledge on.
Yeah, let me just talk a little bit about, you said, like, is ReFi upsetting ESG? Is it a replacement? I think that you can see at Climate Week, we're at this inflection point. Regardless of what you're talking about when it comes to climate, it's all about transparency and like walking the walk, right? And so I think that what ReFi and what, you know, blockchain offers is that transparency and trust. And I think that we don't need to say we don't need standards. We need standards. And you're just saying we can do it more quickly. I think we need to go fast to go slow, and go slow to go fast. And we need to do all those things at the same time. We do need standards. We need to employ next gen technology so that our solutions can be MRVable, for lack of a better term. We need to create an enabling environment. We're going to talk about that, like what drives the market, because we talk about finance separate from, like, most of these projects are not happening, not just because, you know, of the technology or the solution. It's because they're not bankable. There's not a market that can be identified. So we have to be about building markets for ReFi.
That's a good segue, actually, because I was going to ask about enabling regulation, enabling mandates, and also whether, you know, regulation and mandates are too constrictive. Are they overly protective, potentially, of the investor who wants to come into this space? I was actually going to ask Catherine first, who's, I think you're the only attorney on the panel, I'm not sure, but about the various law projects that are, you know, and the regulations are taking shape around ReFi these days. It doesn't have to be in crypto, obviously. It could be just in ReFi generally. Do you see them as overly restrictive these days? What do you see coming down the pike? And maybe they're not overly restrictive. Maybe they're quite supportive. I want to hear what's happening in that space.
I would say right now that we're in a space where I think this space is maturing. They're coming to the table. They're engaging with regulators. I mean, I think the last panel talked about that initial toucan sort of. There was a little conflagration, and what that actually created was the space to have the real conversations about how to bring these sectors together. So I actually don't think we have a big problem right now. I mean, we could talk about crypto regulation next, so we're not going to talk about that. But aside from that, I think it's really about this community showing from a deployment of solutions beyond proof of concept to a level of scale that can create confidence from the regulators. So when I'm looking at the public sector, I see they know what they're doing isn't making sense. That's not getting them the impact that they want, but I don't think we're giving them the confidence. And I think obviously you as VCs can talk about that as well. I will say one thing from a policy perspective is I think we've been a little bit too focused, like I said, on regulation, and somehow there's a special regulatory, sandbox for blockchain. And I think we're missing the point that really where policy comes into play most importantly is in creating markets and creating demand for these solutions. And so I think we've looked at, so say for instance, and I know Lexi, we're going to talk a little bit about this, the larger corporate reporting, the evolution of voluntary to mandatory corporate reporting, as if that's some separate effort around climate. Absolutely not. Until we make carbon data the foundation for everything we do, the ReFi and blockchain supported solutions are not going to scale. So I had the opportunity in California to write the legislation that just Governor Newsom just agreed to sign that will make full scope reporting for billion-dollar corporations mandatory if you do business in California. And people in the blockchain community, when I talked about that, were like, "What are you doing, Catherine? That's like a weird, kind of activisty project over there." And what it really, for me, is looking at the policy environment for carbon markets, for these solutions. I just don't see the enabling environment. And when value chains are disclosed, those large corporations are going to need new solutions. It is going to absolutely galvanize the uptake of carbon markets and solutions. So I think that to me is super powerful. And I love seeing in California the VC community kind of wake up. For so long, blockchain folks have been like, it's not about my blockchain enabling regulation. I'm not involved. And I think the VC community and climate tech in California, which as you know is super robust, realized, okay, this is part of how we get from a certain amount of market penetration to real scale. And so I'm excited to see this all coming together. I'm excited to see VCs and climate tech begin to take themselves seriously, because we do have an existing institution politically, economically, financially. And I think it's just at the cusp of making its way to prime time, which I think will be critical for climate tech, but also just for us and our climate action.
And of course, I couldn't agree more, but I think you both are making the point that the conversation is kind of shifting from offsets to the actual primary data of what companies do need to offset, if they need to offset it at all, because, and I'm very amused by the fact that people think that what you're doing is non-essential compared to other regulations in blockchain, because I'm kind of preaching for my own parish here, but I think tackling climate change is fundamentally about accountability on emissions, and then I'm kind of stating the obvious, but beyond this, then reducing and then offsetting, perhaps. As you may or may not know, there's only 1% of global emissions that are available for offset, so it's not yet a scalable solution to address climate change. So the focus essentially needs to be on the accountability of your emissions. Which legislations like the one that you're mentioning, of course, are critical for. They're not the only one. You have some in the UK. You now have the CSRD in Europe that's extending stuff that was already available in a lot of countries. And what I think this will lead to is essentially, previously you could report a very minimal part of your emissions, your so-called scope 1, your direct emissions, and say, hey, I have offset this. But instead, in fact, you probably forgot 99% of your emissions because they're in your value chain, in your supply chain, who you're buying from. So that's no longer going to be possible. And so the cost of offsetting your emissions is going to go 100-fold. And so it's also going to change the focus of the conversation from the offsetting to the reduction, and I'm always amazed when I come to the US, because I'm normally based in Paris, is everybody saying, offset your emissions as the first thing they think about. And I think this is going to change. It's going to be around the reduction. And to the point on ReFi, to tie the knots together, it means that the certification is not so much going to be around, is your offset real, as is your carbon data real? And so the audit trails, the certifications you alluded to them, are going to be around how do I know really that your emissions from buying from this supplier or from doing this is true. And so that's perhaps where you're going to have a new set of certificates to say, hey, here are my emissions, they are true, or at least I'm confident about them at this level. And so the signaling will be not so much on the quality of your offset as on the quality of you as a company being transparent and decarbonizing.
I think that's a really good point, but I think there's also opportunities in this as well. So there's processes of emissions accounting and there's processes of ESG reporting. And those are generally separate. We have the value chain emissions, which could tie to every procurement relationship for a Fortune 500 company, but it also ties into the credibility of the rule sets you're following. For scope 1, scope 2, and scope 3, oftentimes companies look at simple calculators. Sometimes those calculators don't have that full auditability, and there's many parties involved. Oftentimes auditors come into play, but they're auditing the system and the rules that you've set up. They're not necessarily auditing every single part of the value chain if they don't have the data or the process wasn't set up that way. And so we actually released a paper, I think it was last week, out of the carbon emission task force from the Global Blockchain Business Council, and I know there's some folks in the room, I think Cam back there is part of this as well as a few others. And we talked about the credibility of these systems and the opportunity to evolve them using public ledger technology, putting out the rules so we can actually see the credibility of reporting, because even some factors change jurisdiction to jurisdiction. So understanding what that looks like is already hard enough, but if you have a public ledger to coordinate it, may actually help. And so we take the emissions accounting process and we use that to automate data into ESG reports. We can actually see the granular source of that information. Of course, in companies, it's very different from an incentive and reporting perspective than offsets, right? Data is probably going to need to be a little more confidential, a little bit more proprietary, because certain companies don't want to share their famous recipes or ingredients, whether it's discrete or process manufacturing, or another type of proprietary element of their emissions accounting. And so we have to think about this, evolve this, and so it meets the regulatory requirements, because if we want to build a larger market, it needs to start with transparency, but transparency that works for the folks who are actually doing the reporting, not just for folks here in this room who maybe just buying something as a finished good.
Can I jump in? Because
absolutely.
Wes, this is a plus one for Wes and the carbon markets. Because what I would say is this: anybody who thought that the carbon markets were going to scale with this very weak ESG reporting is mistaken, because we know there is massive loss of confidence in net zero commitments, in saying you're going to do something and really doing it. So we were already there. We absolutely are saving ourselves by making it all about the data. And I would say this: you're going to have a great carbon offset market, but you're going to have to, companies are going to have to reduce first. But then when they need a carbon offset, it's going to have to be a really good offset. No more of this BS. You pick up some stuff and then say you're net zero. So I think at the end of the day, it is actually going to be the best thing for the carbon market and for all of these solution providers. I also want to say, Harbinger, Apple's announcement last week, right, about their big sustainability commitment. And what do they feature? They didn't feature, they've already been doing their carbon footprint. They featured the watch as their net zero watch. And they said, we reduced 75%, and then we got 25% of really highly curated offsets. My prediction is you're going to see products within large corporations, because that's where they're going to be able to actually tell you something is a net zero product before they're going to be able to say their company's net zero. So I think there's a lot of opportunity in these value chains for the blockchain community and for the carbon credit community to really take advantage of that, to go to those corporations and say, let's line up. It's your watch now, but what about your iPad next? So just a thought, and I think, good for all of us.
To add to that, I think I see a common theme between the climate space and the blockchain space, whereas we're demanding thoughtful regulations and clear regulations. Like in the crypto space, we want regulations. We want them to be clear, because a lot of developers are fleeing the US or just blocking US involvement altogether. And one thing about climate is you want the masses involved. You want them to get involved. And when the masses demand certain things, that's when the companies start shifting their focus and offering products that are, carbon offset. And so I think I'm a big believer in less is more. So like less regulation, but thoughtful, clear, and to the point where it's not confusing. And so I think, while I'm hopeful in the US things will change on the crypto side. And I think we're getting there. But, I definitely see that common theme between the climate space and the blockchain space.
Just one thing to add, we talked about offsets in the watch, but I think it's more than just the term offset. I actually think it's impact to those local communities and being able to, when we say audit trails, we don't just mean an audit trail like a Costco receipt of information. We mean information that people can understand. The average person needs to be able to understand the impact that's happening. So if the Apple Watch had a supply chain that touched 3 different communities, 100 different communities, and we could actually bring impact to those local communities, and impact not just of a renewable energy project or a forestry project, but actually with specific elements of that project that made the community whole, made the community better, improved the community, and we could actually isolate those types of opportunities for change and drive sustainable development. And I want to put not just sustainable, but development on it, build capacity in those local communities, conserve different keystone species, improve wildlife and nature. Those types of opportunities to better build models, or our systems, our infrastructure that highlight that information is super important. And so we've been investing in those types of markets to make it very clear what data is available, what type of new attributes, statistics, and how to best price them compared to what exists today in the market. Because if we make everything an offset, a metric ton and a methodology, it's not going to drive the impact that we want. If we highlight the differences of every project, just like the difference of every supply chain, we have a chance to make a really big impact and make every product touch a community in the eyes of the consumer, but also show the impact financially and ecologically in that audit trail.
Maybe just to help clarify, because I'm not sure this is well understood by everybody, you've got the compulsory markets where the price of carbon is essentially a kind of tax, so it's the same price of the ton for everybody. And then you have the voluntary carbon market where you can buy offsets, but essentially there are many, many different kinds. So you have the carbon avoidance projects that you're helping to prevent a forest from being cut down, so that costs $2 a ton of CO2. And then you have the direct air capture that costs maybe $800 or $1,000. And they're widely different, and the prices vary widely. And everybody calls them offset, and you can say you're carbon neutral paying $1 a ton or $1,000 a ton. So talking about regulations, there probably some order to be put in there, and because then you can make wild claims based on very different things, and that's perhaps where you guys have interesting work to do as well, right?
Yeah, I think there's an opportunity to, in crypto you hear fungible and non-fungible, but in carbon, carbon tons, it could be unique metric tons, or projects, or companies could buy from hundreds of different projects. Today it's too hard to do the due diligence on the $1,000 credit versus the $2 credit. So companies take 2 or 3 projects in their portfolio, they buy them, they use them in the voluntary market to offset. I think the opportunity is to use different tools that are coming up. Machine learning and AI is a hot topic. We use machine learning and AI in our portfolio grantees. One being Tolam Earth, who's back in the room today. They use it to determine a carbon price based on the attributes. So don't just look at the PDF coming from a verifier that goes to the registry. Think of that as 2D, think of it as black and white. We have an opportunity to bring things into 3D and into color, where those audit trails actually form the data, definitions, properties that we can better value, compare side by side with other projects. Now that opportunity allows companies to touch and feel those communities in a way that previously was very hard to understand. And so if we can look at a project side by side, understand what drives the price year by year, understand how those communities are impacted, I think that's our opportunity. That's the opportunity for your watch that touched 100 communities, to drive impact. I think that's a big ESG reporting opportunity as well, because those same assets can live on a balance sheet and you can prove in color, in 3D, what's happening.
I think companies have proven their ability to skirt regulation, particularly in a globally connected economy. And it's going to be important to set the rules. It's going to be important to have the accounting mechanisms and the transparency to audit back the decisions that have been made. But it's going to be absolutely essential to have the ability to directly observe the statements and the verifications that have been put out to give credibility to all of this. And with supply chains that are truly global and interconnected, it's going to require the ability to directly observe those. And you're not going to be able to send people out. You're going to have to be able to quickly access information, largely from satellites, that will be able to help you directly observe what's happening, when and where and how.
If I may add, so you talk about sustainability a lot and accuracy of data, but it's clear that offset markets have a big accountability problem. But when you talk about ESG, it's also a bit of a problem because basically the carbon you can have an amazing ESG score and a terrible climate impact, right? And it's been shown and proven over time again that there's zero correlation between a good ESG score, because any company doing ESG has its own methodology, and you can completely water down the climate impact by being super good on other important metrics. So I think the benefit of the regulation that you talked about is that it brings order to this, but in one area, which is carbon, and that's essentially where the accountability will come. So it requires focus as well, which we didn't really have, I think. There's no signaling mechanism today to funnel investments towards low carbon businesses. But there will be, thanks to the accountability that's emerging now.
I think I'm being told we are almost out of time. We covered technology and its applications here. We covered a little bit of regulation. I had another question about the investment process. I don't think we're going to get to it, but everyone here is invited to speak to our panelists separately if they want to talk a little bit more about the specifics of what they do. Thank you, all of you, for coming.